Greetings and Happy New Year to you. My name is Ted Hicks. I'm the Chief Investment Officer for Hicks Associates Wealth Management. Today is Tuesday, January 2nd, 2024, and this is our monthly market monologue. And this time we're going to break it up into two different videos to make them a little bit briefer, easier to digest perhaps. So today we're going to review the stock market. We'll talk about big bases and what we think that projects for 2024. And then on Friday I'll release the second part of the video, and that will be where we'll talk about economics, some of the economic data that we see, and we'll also look into the retirement plan contribution limit changes. And so that said, let's go ahead and dive in. So we'll start by looking at how some of the key indices did in 2023, and we can see at the top of the list we have the code is CompX in our system. That is the NASDAQ. So the tech-heavy index was up about 45%. The S&P 500 was up 24.7. That's going to be a key for you to remember, but we're going to break that down for you in just a second. Next, we have small caps was positive about 15 3/4. The Dow Jones Industrial Average was up almost 14%. Then we have the New York Stock Exchange Average and the All World Index up about 11.5. Then we have bonds. At the bottom of the list, we have bonds. The aggregate U.S. bond ETF had a bit of a rally in the fourth quarter, so it closed out the year at a positive 1.7%. However, long-term treasuries, the second year in a row, ended the year negative. Long-term treasuries were negative 2.5%. So the S&P 500 was up about 24.7% for the year of 2023. But let's break that down, and we need to do that by once again quickly reviewing the cap-weighted versus equal-weighted. And for those of you that have not seen this, perhaps just consider pausing the video and studying the charts. But we've gone through this ad nauseum, so I want to do this really quickly. But this is the Magnificent Seven. The Magnificent Seven are simply the top 7 stocks in the S&P 500. The S&P 500, as it is traditionally calculated, is cap weighted. The larger the company, the more weighting it is given in the performance of the S&P 500. So you can see at the top of the list, you see Apple, and it represents about 7.1% of the S&P 500's traditional calculation. If you break that down and you look at the top 7 stocks within this index, that creates the Magnificent Seven. When you do the math from the prior page, it equals about 26.2%. So 26% of the S&P 500's return is generated from these 7 stocks. What does that really mean? Well, if we were to give every stock in the index an equal weighting, those 7 stocks would represent only a 1.4% return. So what does this mean for 2023? Well, here we have the 7 stocks that make up the Magnificent Seven. We have the weighting from the prior page that I just showed you, and then we show you the performance of each of those 7 stocks. You do that math, and on the far right column, that is the impact that those 7 stocks had to the S&P 500. Do you remember what I told you the S&P 500 did for the 2023 year? Well, this 7 stocks contributed 24.8%. However, the S&P 500 was up only 24.7%. So what does that mean? Well, the reality is the average stock is still negative 9% from its January 2022 high. So the index returns that I just showed you a minute ago, they're a little deceptive because most of them are cap weighted, and the majority of stocks were negative for 2022. But we want to show you now some what we refer to as bases. And there was a gentleman named William Gilers, I think how you say his name. He wrote a book in 1962, and the title of the book was How Charts Can Help You in the Stock Market. It's a classic book, and one of the things that he talked about is what he called, I believe, a dream pattern, and we're going to show you that next. So we're going to wrap up by talking about big bases, and these next couple of charts are monthly candle charts. Every candle on the screen represents a month in time. But before I go on and talk about this dream pattern from Giller's book, we need to explain what the term base means. The reality is when a stock advances, or in this case a stock index advances, it frequently needs to experience a period of consolidation before it can advance any further. The way that I have always thought of this is think of that period of slothfulness that happens right after you eat a big Thanksgiving meal. You have this really big meal, and then everybody needs to take some time and we need to digest it. And so that period of digestion in terms of the stock market is considered a consolidation. Another way that we say this is it is a base. And what needs to happen is we need to see that base form, and as the stock advances out of that base, that's typically when we get a little bit of a more momentum as something moves beyond the base. So in Giller's book from 1962, he talked about something that he referred to as a dream pattern. And I believe in his book, he uses the term a saucer with handle. It has come to be known as a cup with handle pattern. And I'd like to explain it to you here because we see it in a lot of these monthly charts. So here we have the advance. This is the period of consolidation or the period of digestion. This is forming what Giller refers to as a handle. And then this right here would be the pivot, which would be a traditional buy point as something is coming out of a base. To draw it out for you a little bit differently, there's your period of consolidation. This is your base. And again, this is considered a pivot point, and that is traditionally where we want to buy. As something as a stock index or as a stock is reaching that point, that is what we would refer to as a buy point. If we look at that chart and add it back to the S&P 500, that is what we see. Now, the other thing that we would highlight is this form right here is what sometimes is referred to as a little bit of a cheat. We're cheating a little bit we're buying a little bit earlier, because one of the problems in something like this is just because a chart pattern forms, it doesn't mean it's going to work. This is longer than we really have time for in this video, but a chart is doing nothing but showing you visually what's happening, and it is depicting supply and demand. That's all it's doing. But when we see something like this happening, we say, well, if we're going to buy something, we may want to buy it down here instead of waiting for it to climb all the way up here, because if we get stopped out, it's a smaller loss. As again, because so many of our clients are retired or are getting really close to retirement, we think defense first. And so if we buy a little early, if the chart pattern works, that means we get a little bit more of a gain. But if the chart pattern fails, well, we get stopped out at a smaller rate. That's why we consider that a little bit of a cheat. But if we then flip the chart over to the NASDAQ, we see the same thing. We see this cup with handle, and then there's your pivot. And so what these last two candles for both the S&P and the NASDAQ, this is November and this is December. So November had a very strong month up into that pivot point, and then December expanded that and propelled further beyond that pivot. So these are very big bases, and when we see this, we would say this is encouraging for 2024 because we have moved beyond these pivot points. Now, that said, don't be surprised if we start the year off with a little bit of a sell-off, simply because we've had two spectacular months in these main indices. But when we're looking at how we're investing for our clients, we're not necessarily investing in these main indices. This is just a guide to help us to see what's going on in what we call the macro environment. So the fact that we see so many of these points, these bases, and these monthly candle charts, we think that portends good prospects for 2024. We'll look at one more, and this base is a little bit different, but this is your small cap proxy, the Russell 2000. And here we don't really see that cup with handle pattern, but we see a definite sideways consolidation period for approximately 2 years. But here's the good news. We finally closed a month above this period of consolidation or period of digestion. So that is good news. So when we look at these main indices, we're seeing good things. Now, we'll wrap up by showing you the seasonality chart just to try to highlight how good December was. You may recall that when we did the monthly market monologue for the month of December, we showed you that November was a very strong month and it was well above its historical average. Well, here we have the same thing for December. On the chart is the seasonality, or on the screen is a seasonality chart for the S&P 500 from 1950 to 2023. This is showing you your average performance in this main index. And typically the December month is up about 1.2. Well, this December was up almost 4.5, a very, very strong month. And again, when you have something that moves that strongly, there tends to be a period of consolidation or digestion. So don't be surprised if we start the new year off with that. This is a seasonality chart for the small cap 600 index. You can see this index didn't really start until 1995, so a lot less data. But again, historically, December is a good month. This December for small caps was spectacular. So we'll land the plane there for today. I hope you find these videos helpful. If you haven't already, I hope you will hit that subscribe button. Please feel free to share the videos with others. And come back on Friday and we'll show some economic data points, and we'll also talk about updates to retirement plan contributions. Until then, thanks for watching, and we'll talk to you soon.